At Martin Currie, we're looking for undervalued securities, and we believe the best way to find undervalued securities is to identify the intrinsic value driven by the long-term free cash flows of a company. The way we do that here is to use both fundamental and quantitative research. And we look at 4 different lenses to determine a company's worth and where it is trading today. So firstly, the analysts are looking at the fair value of a stock driven by the free cash flow. Secondly, they're looking at the quality and the risks of the business. Thirdly, they're looking at the earnings direction, whether things are improving or deteriorating. And finally, we look at the sustainable income of a company at the low point of its profit cycle. And we think these 4 lenses give us a good perspective on the risk and reward opportunities on each company. Originally, most value strategies were very much based around the concept of a price to book value or a price to a replacement cost. In today's world and how things evolved and for the conditions of the Australian market, where there tends to be less stocks per sector, we think free cash flow is very important in terms of determining intrinsic value, ensuring that we value the growth that a company may have. But it's the combination of of 3 lenses that we look through, of valuation, quality and direction, are very important. Because what we find is that you may have an undervalued company, but if it is poor quality and it has poor direction, it's unlikely that you will realise value from that investment. Whereas, for example, if it's a high quality company, it's more likely to be able to weather the storm of a poor period of direction and realise value. So we see it's very important to understand that the reward on offer from an undervalued security versus the risks of owning something that is undervalued, which might be poor direction or poor quality characteristics. Some of our key sector positions in aggregate are overweight to energy, overweight to consumer staples, and underweight to healthcare and real estate. So in terms of that, we have a view that the long-term oil price is above today's levels. There's been an underinvestment in deepwater oil fields over recent years, given the very low oil price environment, and the decline rates from those large offshore fields will overwhelm new supply coming from, for example, shale in the US. And so we need higher prices in the long term. And so the stocks that we're positioned in that area are Woodside and Oil Search, which also, given their liquefied natural gas exposure, has very favourable dynamics in terms of demand for clean energy from for example, for China. In the overweight in terms of consumer staples, it includes companies such as Woolworths, which we think is a very high quality business given its market structure, market position and market structure with Coles. And now that they've reset their price to a competitive level, they're growing sales and they have a very strong network, and we think that will continue to expand margins. So a company like Woolworths we think is undervalued as a quality defensive business, but at the same time we're seeing areas that are quite exposed to higher interest rates or have benefited from what has been a very low interest rate environment over the last few years, such as real estate and healthcare, and those sorts of names look very expensive in a rising rate environment. In practice, when our analysts are looking at an individual company, not only are they assessing the key drivers of the business and the characteristics of what drives long-term earnings, but they have to go through an analysis process that starts with the governance analysis of the company. So we have a very clear approach of how we look at the governance characteristics in terms of the board experience, diversity, whether there's any conflicts, how the board interacts with management in terms of negotiating incentives, how the board uh, manages its responsibility in terms of adhering to accounting policy requirements, and finally whether the board really knows the business and really hold management accountable for what they're doing. And so that analysis of governance leads to an assessment of a rating where we rate the best companies 1 and the worst 5. And we do similar on other sustainability issues like environmental and social, where we use both our local analysts as well as Martin Currie Edinburgh analysis to identify the key issues in a particular industry. And so when we've done that, that forms one of the building blocks to how we assess the quality of a company. And that quality assessment is used both to determine the discount rate for the valuation for each company, as well as control the position size in terms of risk for the stock. We do this on every stock we cover, and it's incorporated into our risk-adjusted assessment of the merits of owning a company. So initially in that second half of 16, it was a great value period. The world had been quite depressed in terms of China had been slowing down through 2015 and things were beginning to rebound. So you had a really good run for value in the second half of 16, but it has become that much more growth-centric environment. And what we'd say has happened is since the end of 17, growth has become a lot more narrower. It's been, whilst world growth is strong, it's predominantly driven by the US, and we've seen a slowdown in Japan, in Europe, and in China. At the same time, we've actually got the environment that real rates have risen above zero for the first time, essentially since the GFC. And so that's caused ructions in, for example, in emerging markets, but created the environment where people are fearful that the expansion of the economy may end. And so that narrowness of growth, we think, has really concentrated the weight of money towards high quality growth stocks, and they've become very expensive. And so that has been what's created that environment. But going forward, what we can see is that there's a much bigger dispersion between the cheap stocks and the expensive stocks in terms of starting valuation, which is critical. And as we enter this higher real rate environment, we think growth will continue to be strong over the next 2 years. We think value stocks will perform a lot better in that environment than what we've seen in the last 12 months. One of the pieces of analysis we do over reporting season is to look at how company results come in versus expectations and what changes there are in terms of earnings forecasts, and compare that to how share prices responded. One of the generally stock prices in the short term, outperformance or underperformance is driven by a change in the fundamentals and improving earnings expectations. But what we found in the reporting season was that the very high PE stocks at the beginning of the period, for example, they had more than a 30 times average PE, that in aggregate, they had no improvement in their consensus earnings forecasts over the next 12 months through that reporting season. So they didn't report anything that changed consensus expectations for profits going forward. And despite that, their share prices re-rated an average 6%. So they were already the highest PE stocks, and they became even more expensive. And the remarkable thing is that those earnings revisions for the high PE stocks was basically the same as the very low PE stocks. So for stocks trading on only 11 times earnings, they had very similar earnings revisions. So this is quite an unusual environment where you may be rewarded without having deserved it. It will be hard not to be focused on the change in government and what that will mean. And clearly there's issues around electricity prices, and there's clearly the conflict of wholesale prices are rising. People want electricity prices to be lower. There's a lack of recognition from the government of their impact on electricity prices by, for example, providing subsidies to keep the Portland smelter open. So how that plays out will be quite important, and clearly there's discussion of other royal commissions into aged care and potentially electricity, and then what new policies may be implemented by the Labor government. I guess they'll be given a very clean slate in the sense that Australia's economy is looking very good in the sense that we have a current account surplus, and we'll probably have a budget surplus by the time they come in. So there'll be plenty of ability to fund new initiatives and spending, which will likely to come towards healthcare, education, and infrastructure. It's always hard to pin one thing. I guess what we would say is we do expect a more volatile environment over the next few years as we move from what has been a negative real interest rate environment driven by the US to a world where we're going to have positive interest rates. Clearly, that impacted emerging markets first. It's had a big impact on factor performance. It does reflect the fact that growth is strong in the US and that inflationary pressures are rising because growth is moving above the capacity of that economy. On the other side, the risks are all around the trade war and policies that are occurring, and so clearly there is concerns that trade war will exacerbate inflation, potentially exacerbate the need for higher real rates, and has caused this volatility. We don't actually see that at this point it's the end of the cycle. The most important thing in terms of a bear market for equities would be a change in that economic environment. We think we're more in the volatile period at the moment than we are at the end of the cycle. So at this point in time, we're probably more optimistic in the next 12 months in terms of what the market returns would be. The Mueller inquiry could obviously have an impact in terms of what it may come out, but I don't see that as being the big driver. I really see the most important thing at the moment is we have strong US growth. How does that continue in the face of rising inflation given tariffs and a tighter labour market? And does growth return in economies like Europe that have been slowing down? So we head more back towards synchronised growth. I think that will be the most important issue in the face of rising rates. The valuation for the market, given the correction, the PE has come back to quite reasonable levels, and so if we have good growth, that should be the main driver of returns rather than those politics.